Okay. So, as we started talking on the previous day, fraud is alive and well, and there are reports of between 5 and almost even 8% of the revenues are taken as a result of fraud with most companies. And we went on to describe various types of fraud where employees take assets from a company. And another method can happen with higher management, upper management, where they can manipulate the financial statements, usually altering records or bringing revenues in the period that they truly weren't earned. Most common types are by overstating assets, understating expenses, overstating revenues, or understating liabilities. Usually fraud is going to make the client appear in a more favorable position than they truly are. Now, we started talking about various fraud cases. We watched the Tennessee auditor, our friend Dennis, share stories of various types of fraud that he caught. And be aware that, as he said, if you're looking for fraud, a lot of people think they're going to be going out the back door, and it doesn't work that way. They go in and out the front door. In other words, sometimes we're looking for something in the secret where it's right under our nose, the manner in which that they are promoting fraud. CEOs and CFOs can be instigators of fraud in many of the scenarios. Again, part of the problem with the way compensation is created for high executives is a lot of their earnings are based on the profitability of the company. So because of that, they have an incentive to inflate the stock price or instate the profits for their benefit. And it's important for auditors to be able to understand the areas or the incentives in which upper management may have in order to commit that fraud. Revenue recognition is common, where 60% of the cases during the last period was a result of changing when the revenue was actually recognized. We also talked about it's important to be aware when auditors are changed, to ask questions. Why is the auditor gone? To speak with the auditor so you understand what the conflicts were in the previous engagement. There are situations that can need to be discussed in order to limit your exposure to fraud. One, as we show here, is to really be able to understand the company's or the client's internal controls. We've spent a lot of time in this course already discussing the importance of understanding the client's system, the types of transactions that are involved, and really looking at the organizational structure and testing those internal controls. You can see from a purpose of discovering fraud the importance of seeing where the controls are weak, what accounts may have higher risk, and as a result of that, to develop some types of audit procedures that can help locate where there could be potential fraud. Professional skepticism is just being diligent to seek out those potential weaknesses. Now, some of the big companies that dealt with fraud, Enron, was basically the big guys in the room, or the smartest guys in the room. They basically took a lot of their liabilities and they took them off the balance sheet and put them into subsidiaries, or they called it special entities. So those liabilities weren't being reported on the Enron financial statement as a big subsidiary. They took them off. Also, they recognized revenue on certain assets that they had that really weren't even decent assets. These assets were impaired. Instead of writing down the impairment, they basically took them off the balance sheet and showed they sold them to these special purpose entities that really should have been reported as a whole in the financial statements, but they took them off the book so they weren't even being included. So that's a false recognition of revenue. They also engaged in various trades. Basically, they engaged in what they called round-tripping trades. Trades that eventually found the assets returning to Enron after initially recognizing sales and profits. False sales. And all kinds of related party transactions that weren't being disclosed. Because when you're dealing with related party transactions, the opportunity is there for potential, not necessarily dealing in an arm's length transaction. WorldCom was another winner, where they basically took various types of transactions that really were expenses such as renting cable lines, and instead of treating them truly as a rent, what they went, or an expense, what they did is they capitalized those line costs, these phone rentals that they paid to other phone companies. They should have treated them as a rent. They instead capitalized them as though that was an asset. So as a result of doing that, they ended up showing so many higher assets and a lot lower expenses. I need to get in. Does anyone have a Kleenex? I'm sorry. Thank you, darling. Oh, you're so good. Thank you. So in WorldCom's case, it was twofold. What should have normally been an asset or an expense, a debit to expense, they debited an asset. So they made the financial statements or the balance sheet look better with assets, and then in addition, they showed that equal amount of reduction of an expense, which was an increase in income. They restructured reserves, accrued reserves. I mean, they just manipulated the books to keep the price high. And then Lucent also did some channel stuffing, which basically pumps up the sales at the end of the period to make the income look higher. We've got Pamelot, Health South, Attico. I mean, it keeps going on, all of the fraud that occurred. Health South basically faked revenues, recorded fictitious revenues across its 250 clinics and hospitals. So billing group psychiatric sessions as individual sessions. I mean, they just faked it all. So it's important to kind of look at the past so we know where we're going in the future and hopefully not replicate those behaviors. The auditor should not be pressured by the client's desire to release annual earnings at an early date. Pressure can allow you to skip steps, so you can't be pressured by the client. The auditor must dissect complex transactions to determine their economic substance and the parties that have the economic obligations. Again, in this economic condition and times, some of these transactions that are processed with companies, it almost takes a doctor in the specialty to really even understand the maneuvering of transactions. So it's important as an auditor, instead of it being complicated and you ignore it, you have to all the more have an understanding of what really is happening, what economic event is really occurring within these transactions. Auditors must use basic audit procedures like testing, additions to capital, performing cutoff tests, examining the documentation to support any kinds of costs or sales, going back to the basic audit procedures that we've talked about. And then the auditor might have to go beyond all that, just to make sure that assets really are the rights of and the title of the company, and that it's not necessarily titled to another party or company. The auditor also has a responsibility to detect any material misstatements, whether they're intentional or just errors, and if they're defalcations or fraudulent financial reporting. The key here, guys, is the auditor has to detect material misstatements. It doesn't matter if that material misstatement is from fraud or from just an error, they have to detect material. Fraud, though, has some extra pieces that make it harder sometimes to detect. It's meant to be covered up. Is an error always meant to be covered up? A mistake is a mistake. Sometimes you'll find it easier because it's not intended to be hidden. Fraud is always intentional. It's an intentional act to deceive and is intended to be covered up. So a lot of times the uncovering of it can be more complicated. Do you remember us looking at that video yesterday and how the treasurer would show a deposit, and when we got the bank statement back, it was the same deposit, but it was only in seeing the detail from the bank of what made up that deposit did they find out how the fraud was actually taking place. So they want to cover it up, okay? All the more important to receive confirmations and go that extra mile. It often involves top management who have the ability to override existing controls. So you want to believe that the controls are in place and you can test them, but unfortunately when the higher up you go, the higher up you have that ability to override those systems in place. Complex transactions can be a conduit for fraud, in that they're hard to understand and they're hard to be able to decipher. So complex transactions really need to take the time to understand what's involved and the parties involved. Fraud always starts out small, and I would have to say it's always almost caught. It's just a matter of time. The attitude of professional skepticism is an important aspect within the auditor, just to always have a mindset of how fraud could occur. The integrity and the culture of the company, the integrity of management, is also going to be a warning sign and potentially a symptom of fraud. If there's an attitude of cutting corners and pushing the sales no matter what, that might present a greater possibility that fraud could be presented in that company. Identify fraud risk factors. So there are going to be specific things we're going to look at in dealing with fraud. Look at journal entries that really aren't in the norm of the processing, and check them out. Look at the estimates related to any accounting estimates to see how they could be overstated or understated. And any unusual transactions that aren't within the normal course of business, pay attention to why the business may be, why would they have transacted that type of activity within the company. Red flags are the key. The planning process alerts auditors to any potential problems that could be out there. And when you plan the audit, you've got to consider the risk of fraud and ways in which you gain an understanding of how fraud could be evident is by knowing the business, knowing where the risks are, understanding how the economy is and how this business is dealing with in the economy, and management's possible motivations to increase sales. There are certain areas that are going to be greater risk than others. Be able to identify where is there a lot of cash that's trading hands instead of going through paper transactions. What employees? Earmark those employees that could have a potential of being able to commit it, having an opportunity to commit it. Fraud. Did you guys hear Dennis talk about in the video we saw that they even check out the employees and how they live their lifestyle based on the money they make? They're checking out if Susie's driving a new car, how did that money, how did they afford that money based on the income? Now, there might be totally logical explanations. The husband may have gotten a great job. They could have an inheritance. They could have won the lottery. There's got to be reasons behind people's behaviors, okay? So if someone is taking a trip every month and they're spending $5,000 a month just taking trips, where's that money coming from? Okay? It just, sometimes that feels a little invasive, but the point or the purpose of the auditor in doing this is just to get a broad view of anybody's lifestyle changing drastically. All of a sudden, someone that was used to wearing costume jewelry, all of a sudden you can tell, has just received about $200,000 of jewelry. Where'd that come from? Okay? Maybe it's a new lover on the side, but, you know, somehow they're getting it. Somehow you got to explain that one, right? What are you guys laughing at? Okay, anyway, moving on. The financial statements analyze current changes in the company's financial results. You know, again, when things are consistent with year to year, or they're consistent based on what the budgets were, the planning was, then there's a benchmark to be able to fall back on. Those ratios between year and year in the industry sector are based on budget numbers to feel safe on those figures. Professional skepticism can go a long way in looking into fraud. 10 general steps to an audit related to integrating fraud risk. Understand the nature of fraud, types of fraud that can occur, who is motivated to do that fraud, and how would it be perpetuated. As the group of auditors get together to brainstorm opportunities, motivation, and rationalization for fraud, get information in identifying and assessing potential fraud risk, identify specific risks, and then check out those companies' internal controls to see that the controls are in place to avoid any possible fraud. You might have to adjust certain audit procedures. Again, gain audit evidence, communicate potential links that may be happening related to fraud, and continue to document and start over again if you need to. Again, oftentimes fraud can be uncovered in just performing the audit, just like Dennis was talking about with the bank deposits. They were just doing a normal procedure, audit procedure, and found out how that was uncovered because the detail didn't match with what the government entity reported the detail to be in the accounting records. The fraud triangle, we have talked at length, or I should say at nauseum in here. Incentives to commit fraud, the opportunities to commit fraud, and the way people rationalize the fraud. Management compensation schemes is one of the biggest. Everyone wants to make more money. When the compensation is tied to the profits of a company, it's just a fraud, unfortunately, waiting to happen in many scenarios. Any financial pressures to make the earnings look better or have the balance sheet look a little more balanced on the asset side. Any needs within employees, and ultimately personal wealth gets tied to financial statement results or even survival of a company. And a lot of these are going to be the same type of pressures in various companies, but be aware of those. How do you know warning signs are there? The internal controls are non-existent. The organizational structure is either mismatched or just so complex to follow. There's not direct lines of authority. Monitoring management. Either the management is too dominant and the board of directors is too lackadaisical, but there's not the proper authority lines of accountability. Everything's made by management, significant accounting estimates. Are they documented as to how these estimates are derived? When there's a lot of related party transactions, that doesn't necessarily mean that there is fraud occurring, but it's definitely something that needs to be looked at. Why are there related party transactions? Industry dominance. When you've got a company that is in the position to dictate to suppliers how things are going to be, one needs to just look at how their position within the industry can affect the other players. Just notice the transactions. Be aware of knowing that this is an economic event, and you need to be able to decipher that economic event. When they become too difficult to comprehend, then you ask yourself why. Rationalizing fraud. Here's some really good statements as to how people think of their behavior. Oh, this is just a one-time thing to get us through the current crisis. Things are going to get better. It's only going to happen once. Or guys, everyone kind of tells a little white lie on the financial statements. Or if we don't do this, we're going to get in trouble and we're going to have some debt violations. Or guys, we got to get a higher stock price because we have long-term plans of merging or buying this company and we've got to look good. So it's all for the good. This rationalization isn't always just about an individual making money. It's for the benefit of all the employees, the whole company. Oh, the city. Look how many employees the city hires. We got to keep this city happy. Brainstorming in SAS 99, this requires the team to get together and discuss potential ways that fraud can occur. And this brainstorming of the group is meant to it's twofold. Help the inexperienced auditors understand the process these experienced auditors go through in brainstorming, and promote this professional skepticism within the group as a whole. What gets discussed in this brainstorming is how it can happen, how it can be hidden. No, it could so likely happen within the revenue recognition cycle, and to be able to follow through the process in which revenue could either be just derived from falsely or could be a timing difference. Look for incentives, look for opportunities, and look at the industry, the economic conditions, and just the financial stability of a company. Generally speaking, the more financially stable a company is, the less their need would be to look better. It's more when you're dealing with tough times, tough market, tough economy, that those potential nudges are going to occur. So SAS suggests the auditor consider greater susceptibility of evidence manipulation or skepticism of management responses. Look at the journal entries. Check out any new technology that's happened recently for ways they could commit fraud. Recognition that collusion may be likely. It might not just be one person. There could be a couple people operating together to falsify the revenue. And know what your intentions are with these audit procedures, what you're intended to have the results be. And again, analytical procedures, if we look at what the comparisons, that's going to help keep us consistent within year to year and understand where the changes may occur. Here are some reasons we would be suspicious. If all of a sudden at the end of the period there's huge revenues coming in, it's a warning sign. Sales increase faster than what the industry says, it just doesn't smell right. That's going to be a warning sign. If all of a sudden the gross margins increase significantly from previous periods, why is that happening? What's all of a sudden changed that makes the margins higher? Large number of sales returns after year end, so they book the sales and then lo and behold, these sales didn't follow through and they got returned. Increase in number of days sales and receivables, so they're sitting in the accounts receivable for a longer period of time than usual. That might be evidence for some concern. Number of days of sales and inventory. The increase in debt to equity ratio changes should be a need to look at what's happening. Why has the debt increased? What's going on there? Cash flow problems, and anything that's changed as a result of performance measures that aren't financially linked. So I think